Now, Middle Eastern countries are facing budget deficits totaling $320 billion over the next 5 years. That is according to the International Monetary Fund. And the reason? Low oil prices, of course. So it's no surprise that it's urging the region to continue to diversify its economy away from oil. Now, the IMF predicts oil will trade between $50 and $60 a barrel for the medium term, and that's likely to carry on through into 2018. Brent crude's trading at around $61 a barrel currently. Now, that would be enough for countries like Kuwait, Qatar, Iraq and Iran to run budget surpluses, while the UAE will just about balance its budget at an oil price of $60 a barrel. But Saudi Arabia, Oman and Bahrain will need oil to trade between $70 to $95 a barrel to catch up. For Saudi, this is much lower than what it's previously needed in previous years, and that shows its diversification plans appear to be paying off. Let's get more on this now from Nitish Shah, who joins me from London. He's a commodity strategist at ETF Securities. Great to have you with us on Money Talks. Nitesh, firstly, what's your reaction to the IMF's estimates? Do you think that they're realistic here?
Yeah, I think that there's a decent dose of realism, but one of the real stories is comparing this report with the one last year, and you can see there's been a significant amount of data revision in terms of the estimates of the break-even fiscal cost from 2016. So what we're seeing is a lot of postponement of the actual improvements taking place. So what was expected to have improved by 2016 has been now pushed over into 2017, into 2018. Saudi Arabia is taking a lot of effort to reduce its cost outlays. So it has significantly reduced its subsidies towards fuel for fuel consumption domestically, and reduced a lot of its social spending programs in order to face the new reality of lower oil prices. But it's still got a long road to go ahead. And with its Vision 2030, it still has to diversify its economy quite significantly.
Indeed, and in fact, Saudi Arabia have said that next year they're going to have to increase spending. They've had enough of austerity for a while. Isn't this going to push forward, or push back rather, that date at which they can balance their budget?
Yeah, I mean, it's going to be a very tricky balance to make. On the one hand, they need to contract their costs to be able to remain financially stable. But at the same time, if they cut back on costs too much, they could risk social disapproval. And, you know, this is happening like a decade on from the Arab Spring, where in other parts of the Middle East there was a social uprising, and Saudi Arabia was able to escape most of that because it increased its spending program. It doesn't want to end up in the same situation a lot of countries were a decade ago. Right.
Now, Nitesh, as oil prices come up, do you think that once again US shale oil producers could plough right in and flood the markets once again? Or do you think that they've hit a bit of a ceiling in terms of the efficiencies that they can squeeze out of their operations? Do you think that overall we've turned the corner on the global oil market?
No, I think the US will continue to expand production. At these prices, around $60 a barrel, a lot of shale in the US is very profitable. We're going to continue to see an expansion of production. By 2018, the US is going to be producing more than it ever has in the past. It will surpass its 1976 high. And what is clear is that there's continual improvements in the cost structure in the US. It may not be as strong, the improvements in cost structure that we've seen in the past few years, but it will continue.
Nitesh Shah, ETF Securities in London, thank you very much indeed.